Hi everyone, and welcome to the final installment of our three-phase portfolio strategy. Today we're walking you through phase 3, the tactical alpha and alternatives component. If phase 1 was about structure and phase 2 was about timing, phase 3 is about conviction. This is where we introduce intelligent asymmetric exposure and deploy capital when the window is narrow but the opportunity is significant. Markets are not short of information, they're short of interpretation. What phase 3 is built to do is identify those moments where the market has fundamentally mispriced something, whether it's valuation, timing, or access, and strike before consensus catches up. This isn't about taking wild risks, it's about calculated, high conviction positions when conditions line up. Think of phase 3 as a high performance overlay. It only makes up a small percentage of the portfolio, but it's where we go off benchmark, where we step away from the passive allocations and use alternative structures, private placements, and tactical timing to capture alpha the index won't give you. Opportunities typically fall into one of three buckets: public market mispricing, undervalued stocks with a clear catalyst, thematic structuring, creating custom products aligned to our macro view, and private market access, early stage or digital infrastructure plays that require timing, diligence, and access. All of these are rigorously vetted through our research division and investment committee. In public markets, we look for companies where price significantly lags intrinsic value, and we have a visible reason that gap is likely to close. Think earnings season surprises, guidance upgrades, corporate restructuring. These are moments where price action can re-rate quickly. We aim to position before the market recognizes the shift. When the market doesn't offer the exposure we need, we build it. Structured products allow us to tailor investments to exactly the market conditions we see ahead, whether that's range-bound markets, rate shifts, or thematic baskets. In digital assets and early-stage investments, we allocate only where governance is sound, valuations are real, and thematics are compelling. We don't believe in arbitrary sizing. Instead, we scale exposure based on liquidity, confidence in timing, convexivity of the return profile. Large sizing is reserved for high certainty liquid trades. Smaller asymmetric allocations are reserved for more complex or frontier ideas. Every position is contextually framed within the broader risk lens of the total portfolio. There is no rigid scorecard here. Conviction is a process, a balance between the internal belief in the thesis and external validation via market signals. We constantly assess, has the thesis strengthened? Has the market caught on? Are we still early, or is this the window closing? This isn't checkbox investing, it's dynamic capital allocation. Every phase 3 idea is reviewed and ratified through our investment committee. It doesn't matter how exciting the trade is, if it doesn't pass the fit for purpose criteria, it doesn't get on the board. We prioritize clarity in execution, precision in risk, and tight integration with our core strategies. Phase 3 doesn't float independently. It complements the macro thematics of phase 1, and it aligns with the market positioning signals of phase 2. That integration is crucial. It ensures we're not over-leveraging a single view and that every exposure reinforces our broader intent, not competes with it. Phase 3 is how we stay agile, intentional, and opportunistic, without compromising structure. It's about being able to act when others hesitate, to allocate when risk is misunderstood, and to capture upside that broad markets can't offer. This is tactical, this is deliberate, this is where conviction meets execution.